What is happening with the stock market? How is it going up so quickly during one of the roughest years the economy has ever faced? And more importantly, what can we learn from it? Well, as it turns out, there's quite a bit we can learn from it. So let's talk about how the stock market recently had its best 100 trading day stretch since the Great Depression, what we can learn from the markets this year, and what all this means to us as investors going forward. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So first of all, what happened? Following one of the fastest market drops in recent memory, and in the midst of unemployment numbers spiking to levels that we haven't seen before in our lifetimes, the S&P 500 just posted its best 100 trading day stretch since the Great Depression. On February 19, 2020, the S&P 500 closed at an all-time high of $3,386. By March 23, 2020, it had fallen to a low of $2,237. That's a near 34% drop in about as many days. And at the time, we weren't sure how much lower it could go. There was a lot of uncertainty surrounding the markets, and to a point, there still is today. But to the surprise of many, the market would rally quickly, and over the next 5 months, it rose to set a new all-time high of $3,389 on August 18th. That means that this particular crash cycle took almost 6 months to the day to go from peak to trough to new peak. It also means that those who were invested in the S&P 500 have seen their investments recover and grow by over 50% over the last handful of months, which is the best such stretch since 1933 when the markets were recovering from the Great Depression. But how many people could have predicted that happening back in March? Not too many. And that's how it always is with these downturns. It's nearly impossible to tell exactly how bad it may get at its worst, or how quickly it'll recover in the moment. We can look back at history and take comfort in the fact that it has always recovered eventually, and we can also look at how long it typically takes for that recovery to finish, but we'll never know for certain what path the markets will take until they've already taken it. Given that, one lesson we can take away from this most recent downturn is one that we've already discussed in the past, and that's that timing the market is usually a bad idea. Sure, we may get lucky once or twice, and some people did this time around. We may get out before the downturn really gets going and get back in before the bulk of the recovery has happened, but over the long haul, the odds are not in our favor as individual investors, and the costs of missing out on even one of these volatile periods can be pretty substantial. A while back, we covered how missing even just the best 10 trading days of the market over the past 40 years could have cost someone almost half of their nest egg. The same holds true during these longer uncertain stretches. However, it's possible that sitting on the sidelines during longer uncertain stretches like the one we've been experiencing for much of this year could be even more detrimental than missing a few great trading days. Not necessarily because you miss out on more gains or dividends. I mean, you might, depending on how long you stay on the sidelines, but more because it's so easy to fall into the investor trap of waiting for the markets to correct to where we think they should be. Let's say that John sold his investments when the markets bottomed in March. Not only would he have had to watch the markets respond with a surprisingly strong and rapid rebound, but the broader economy is still far from being out of the woods. Unemployment is still high, the virus is still out there, and it is still spreading. Some places have had to pause some of their reopening plans, and yet the market is still going up. Wouldn't it be easy for John to think, you know what, things are pretty volatile right now, and the movements of the markets over the past few months just don't make much sense given all that's going on. Surely they'll have to come back to reality sooner or later. I think I'll wait just a little bit longer until the markets correct themselves before beginning to invest again. Now, it's entirely possible that John will be right, and that the markets will eventually plunge back down to some degree. I don't know, I don't have a crystal ball. But what if he's wrong? What if the markets mostly hold steady, or even continue to rise in the near future, which actually hasn't been all that uncommon in similar situations historically, as we'll cover later in this video? How long is John going to stay on the sidelines, missing out on those gains, those dividends, and those extra shares that he could be buying with his ongoing contributions during that time? And is that risk worth the potential reward of not experiencing another drop? Ultimately, that is a question we all have to answer for ourselves. Personally, I lean towards simply staying the course because history suggests that most downturns don't last too much longer than a few years, and some don't even last that long. Let's talk about how this run-up compares to other recoveries and what typically happens in the markets after a run-up like we just experienced. So while this most recent 51% or so run-up wasn't the biggest from a price appreciation standpoint, That honor would go to the 100 trading days starting February 14th, 1933 and ending in July of that year, when the markets rose by a whopping 93%. It was the biggest since the Great Depression, beating out the 44% rise we experienced from March of 2009 through the end of July. However, it was one of the fastest recoveries from a market crash, at least defined by a drop in the price of the S&P 500 of at least 20% from a previous high. The roughly 5 months that it took for the market to recover from bottoming out was only beat by the crash of the early 1980s for fastest recovery. On November 28, 1980, the S&P 500 stood at an all-time high of $140. Over the course of the next 21 months, it would fall to as low as $102. By November 3rd of that same year, the S&P 500 set a new all-time high of nearly $143, making it the fastest recovery from a market crash since the Great Depression. Though obviously it took longer to drop to its low point, so this most recent downturn would still be the fastest full cycle we've seen since the Depression. The crash of the mid to late 1960s also came close to beating out this most recent crash in terms of recovery speed, but with a low of $73 being set in October of 1966 and a new high being set the following May, it did come up a few months short. Which brings us to a second lesson to take away from this most recent downturn, and that's that crashes have always been temporary. On your screen now, you'll see how long it took every other major market crash since the Great Depression to recover. You'll notice that for the most part, these crashes tend to recover within a couple of years. The obvious exceptions being the stagflation of the 1970s, the dot-com crash of the early 2000s, the Great Recession, and of course, the Great Depression. But even those eventually recovered. And as we covered earlier this year when the market was just beginning to experience serious levels of volatility, most of the smaller shocks that don't quite get to the point of being classified as market crashes tend to recover within about 6 months to a year on average. We don't talk about them as often because they obviously have a much smaller effect on our financial lives, but as we do tend to see more of those 5, 10, or 15% temporary downturns than the 20 or more percent variety, they are still worth keeping in mind when trying to establish what is typical during and after market turbulence. Now, does that mean that it'll be that way forever and ever? Probably not. It's certainly possible that eventually we'll run into some sort of black swan that's so devastating that our entire way of life will be damaged beyond repair. But short of something like that, if we're taking care to make sure our investments are well diversified, we should be alright over the long run. And historically speaking, even over the short run, there's a decent chance we'll be alright. Let's take a look at how the markets have performed historically following major market run-ups, such as the one we just experienced. I went back through the daily closing price data of the S&P 500 per Yahoo Finance to find every instance where the markets rose by at least 25% over the course of a 100 trading day stretch. I then further narrowed down the list so that we only have the best 100 trading day stretch from any given year, because otherwise we'd have ended up with dozens of days from several of these instances and it would have skewed the results. That process left me with 15 examples, which you see on your screen now. I then looked at what the price of the S&P 500 was at various intervals following the end of that 100-day stretch. So for instance, the most recent example before this year was the stretch in 2009 from March 9th to July 29th. The S&P 500 started the run-up at $676 and ended at around $975 for about a 44% increase. 1 month after that July 29th finish, the S&P 500 had risen further to $1,028. 3 months after the end of that huge run-up, it was sitting at $1,063. It continued to rise at the 6-month mark as well as the 1, 3, 5, and 10-year marks. I followed this same process for the other 14 examples. And what we see is that, historically speaking, at each and every interval, there's a greater than 50% chance that the markets will be worth more than they were at the end of their major run-up. Now, this is a small sample size, and some of the intervals were close, such as the 1-month and 5-year intervals, which both grew in 8 of the 15 examples, but it is still encouraging to see that, even in the short term, and even without factoring in things like the reinvestment of dividends or our own ongoing contributions, there's historically been at least as good of a chance as not that the markets would grow further. What you'll probably also notice is that the majority of the instances that failed to grow further occurred in the periods directly leading up to and during the Great Depression, which, from a price appreciation standpoint anyway, the S&P 500 didn't fully recover from until around 1954. If we look at the data since the end of the Great Depression, we notice a couple of things. First is that the only interval that failed to grow at least 75% of the time is the 1-month interval, which grew in 5 of the 8 examples following the end of the Great Depression. We also noticed that in all 8 instances, the markets had risen further a year after the end of their major run-up. And it wasn't a tiny increase either. On average, since the end of the Great Depression, the markets have grown a further 12% in the year following the end of a major initial run-up. There was some variance, with the lowest growth being 5% taking place from 1980 to 1981, and the highest growth being 26% from 1986 to 1987. But again, that's without counting dividends or our ongoing contributions, both of which could push those averages higher when it comes to the growth of our actual nest eggs. So what does this tell us? Well, it tells us the same story that literally every other downturn has since the Great Depression. Timing the market is generally a risky move over the long haul. Crashes have been temporary, and the best thing we can do is focus on what we can control instead of worrying about the things we can't. So what can we control? We can control our asset allocations and how diversified we want to be. It's in our control to decide that, barring some major emergency, we'll continue to invest regardless of what the market is doing. It's in our control to prioritize having an emergency fund in place at all times, so that if something should happen, we don't have to immediately run to cash out our investments, especially since some of the bigger emergencies, such as job losses, tend to come more often at those times when we'd rather not have to sell our investments. And we can, to a pretty significant degree, control our burn rate so as to get the most out of our emergency fund if we find ourselves in a situation where we need to use it, or just to get the most out of the downturns where we're able to invest more when the market is on sale. We can't really control the day-to-day price fluctuations of the market itself, or the behavior of other investors. But thankfully, if we do well at controlling those things we can control, we'll probably never need to. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.